The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast with me, Dominic Frisby. It is February the 6th, and in today's programme, I'm talking to Ian Gordon. Ian was born into an English military family, but he's been based in Canada for some 45 years now. He's worked in the financial markets as a broker and an analyst for over 30 years, and he's one of the foremost proponents of Longwave theory, of Kondratieff theory. Ian, it's a pleasure to be talking to you once again. You've been saying for some time now that there are 4 seasons to the Longwave cycle, and we're very much in winter. Are you still standing by that?
I certainly am, Dominic. This winter has been extended up to this point in time by the central banks printing copious amounts of money, and but they really haven't got to the crux of the problem that occurs at the onset of winter, which is eliminating most of the massive amount of debt that's been built into the economy during the previous 3 seasons of the long wave, and particularly during the autumn.
Very good. And so even though, stock markets are nearing to, or some of them, certainly not the Canadian markets, but the S&P and the FTSE are closing down on their all-time highs. Of course, the stock market and the economy are 2 very different beasts. But a central banker might say, well, actually, printing's worked. Look at the stock market.
Well, that's right. It's worked up to this point in time. In fact, effectively, what we're seeing is 3 highs in the winter bear market. The initial high was in 2000 when the Dow hit 11,750. The secondary peak was made in October 2007 when the Dow hit 14,200, and now we're making a 3rd peak. And interspersed between those peaks, there's been some fairly vicious downside action. And we feel that when this ultimate peak is made, and it could be significantly higher than the 14,200, when that peak is made, the winter bear market cannot be held back any longer. And, we're a big proponent of markets being effectively managed by natural law, and what we've seen here is central banks have been trying to impose their own will on the natural way of the markets, and so far they've been successful, but we feel that success is going to be completely destroyed in the coming down once this new peak has been made. And we have a target for the Dow of 1,000 points, the ultimate bear market bottom. And we picked that level simply because this winter bear market is akin to the winter bear market of 1929-32. And that bear market lost 90% of the Dow's value. And we picked 1,000 simply because 1,000 was a very strong resistance point. Initially, 1,000 was hit in 1966, and it took 12 attempts for the Dow to penetrate 1,000 and move on, and it finally did that late in 1982. So that resistance point now becomes support. So, and again, we're looking at something akin to the 90% loss that was encountered between 1929 and 32. So 1,000 seems to be a realistic number for a winter bear market.
Now, 1,000 on the Dow, that's a hell of a big target. That's a loss of, goodness knows, more than 90%, 95% from here. You spoke about natural law there, Ian. And if natural law is the law of nature, and positive law, I think it's referred to in philosophical terms, is the law of man, where we try to assert our own laws on the law of nature. Fiat money is very much a positive law, and gold, which is, of course, world supply grows at the same rate as population growth, is very much a natural law. I can't see how, measured in an artificial form of money, how in positive money terms, the Dow is going to get to 1,000 points. It's with money printing and everything else, I just cannot see it happening. I can see it doing the equivalent in gold terms. In fact, we're not far away. I think the Dow to gold ratio is 6 or 7, and it might ultimately go back to 1 or 2. But in fiat money terms, you think the Dow is going to go to 1,000 points?
Well, I think actually what we're going to see is the destruction of fiat money and the return to natural money and gold. So in that destruction of fiat money, and we've never seen a fiat money system that has ever survived. And in fact, what we're seeing is the central banks are trying to maintain the fiat system by frantically printing even more of it. And that's, if we go back in history and look at some previous fiat money experiences, the response of the governments in those times, such as the John Law fiat scheme or the Assignat scheme of revolutionary France, you can see that when the thing starts to collapse, when the monetary system starts to collapse and all confidence in that system basically is lost, the government's response is to continue to print even more of it. And we're essentially seeing that now, but I'm sure that eventually we're going to return to a natural money such as gold, and it's possibly going to happen, I would suspect, in China. Essentially the world's monetary system is generally governed by the largest creditor nation. And the U.S. has lost that distinction a long time ago, and China is amassing as much gold as she can get her hands on, and I think eventually we'll see the renminbi tied to gold.
You say that if you look at history, no fiat system has ever survived. But if you look at, say, the pound, obviously it was tied to gold for a long period. It was revalued several times within that period, and we had one great revaluation in 16, I think it was. We had another in 1816, and then of course we came off the gold standard in 1914. Then we went back on it in 1925 and came off it in 1931. But if you look at the pound, of course it keeps losing purchasing power over time, but it still survived.
Yeah, it has survived, but I suspect that it might still survive, but eventually what's going to happen is that the pound is going to be forced back to basically be on a gold standard system, because China is going to call the shots in this game, and if the renminbi gets tied to gold, and I'm pretty confident that is going to happen because of the frantic amount of gold that China is amassing at this time. If that happens, it essentially forces every other country to follow suit, because if they don't, then no one essentially wants to trade with those countries because they have no confidence in the money in which their goods are being paid for. So you can't have an international monetary system has to evolve, but the leadership has to come from the largest creditor nation. And when you go back and see that, Britain went onto a gold standard. Actually, you were almost exactly right on 1717, and effectively came off that standard at the onset of the First World War in 1914. Went back on a quasi-gold standard system in 1926, and then, of course, went off that system in 1931, and the whole world monetary system effectively collapsed between 1931 and 33. And world trade essentially collapsed and lost 75%, dropped by 75% during that period, because there was no confidence in anybody's money, except maybe the dollar. But that the U.S. had also gone off the gold exchange standard system in 1933. So effectively, the world's been on a pure fiat money system since 1933, but one could argue it effectively since 1914.
Yeah. And now, how do you explain, most of the listeners to this show are gold bugs. We're very pro-gold. And, we've got stock markets, as I say, closing down on their all-time highs. Gold, on the other hand, has been a bit of a dog over the last 18 months or so. It's been flat at best, and gold shares have been utter dogs. How do you explain that?
Well, actually, I think it's quite simple to explain. And we explain it, in our work in the long wave. Effectively, gold and the general stock market are always working opposite to each other. So when people are invested and pushing their money into the general stock market, there's no interest in gold because paper is gaining in value and more and more people are going into the paper assets. But when that system starts to collapse, people move out of those paper assets and go to gold because they see it as a safe haven. And, you can actually do this, effectively measure this quite well by using the Dow Gold ratio, the value of the Dow Jones Industrials divided by the value of an ounce of gold. And you'll see that during the long wave seasons, that ratio fluctuates from a very low point, 1-to-1, to a very high point. So when the Dow, for instance, the high point is reached in that ratio at the end of 1966, and that happens to be the end of spring. Well, in spring, stocks do very well because the economy is starting to sort of gather momentum during the spring after the devastating winter. And then in the summer, gold does very well and stocks don't do well. Summer is always a period in the cycle. It's the inflationary period in the cycle because there's always been a war that's been financed by money printing. So you've had inflation in the summer. And the first cycle, it was the War of 1812. The second cycle, it was the U.S. Civil War. The third was the First World War. And the fourth was the Vietnam War. So you had this massive money printing to finance the war, and you have a big inflation during the summer. So gold performs very well. So the ratio at the end of summer in 1980 reaches a 1-to-1 ratio. Gold and the Dow are valued essentially at the same. And then in the autumn, that's always this period of the biggest bull market in stocks, bonds, and real estate. You can go back, and our autumn started in 1982 when the Dow bottomed at 777 and completed in 2000 when the Dow hit 11,750. In July of 1999, the ratio, Dow Gold ratio, was almost 44-to-1. In other words, it took 44 ounces to buy the Dow Jones Industrials. From that peak, even though the Dow is at, closing in on an all-time high, we're about 7.5. We've gone from 44 down to about 7.5-to-1. And we're going to go down to an extreme low ratio. And I believe that ratio is going to be lower than the 1-to-1 that we've experienced twice before in this ratio measurement, simply because I do have a price of 1,000 on the Dow, but I expect that gold will be at least $4,000 an ounce, so it'll be 1/4-to-1. And that's the kind of, but you can see these changes in the ratio values always seem to change at the conclusion of the seasons, the long wave seasons.
So, okay, so we're in a kind of manipulated winter, if you like. What should we be doing with our money now? Where should we be putting it?
Well, I think, it's certainly where I put my money, and where my money's been since 1999 is effectively in gold. And and therefore the results have been pretty good by being in that, in that medium. So both in the gold stocks and in gold. Yes, we've been in a period, that's not been good for gold and investments in gold, but we think that once the Dow peaks, and we suspect it's going to happen probably, no later than the end of March, beginning of April of this year, that once that Dow peaks and starts to come off, we'll see the move returning to gold and out of stocks, and people going back to gold and to the gold equities, because we can go back to the last winter and see exactly the same thing happened, that once the Dow started to come off, the move to gold equity and to gold itself was enormous. I mean, you can just see it by the amount of capital that flowed into the gold mining industry at that time. Simply, the number of mines that were discovered in Canada and all along the Abitibi Greenstone Belt in Ontario and Quebec, in British Columbia, and also in the U.S. There were 9,000, according to the U.S. Bureau of Mines, there were 9,000 operating gold mines in the United States in 1940. So that meant that capital was flowing almost exclusively to the gold mining industry. People wanted gold.
Do you know how many operating mines there are now?
In the U.S.?
Yeah.
Oh, I would say, you'd be lucky to you'd be lucky to see 500.
Yeah.
So that's and it's the same. I mean, if you look, the number of mines that were discovered and put into operation in Canada in the 30s, it was enormous. I've got to actually have a list of them. I haven't counted that list, but you can just see that all these discoveries, like a Cisco's mine that's now operating, was discovered in 1933, put into operation, the Malartic mine.
Yeah.
A company that I like called Temex, its mine was put into, it had 3 operating mines on one of its properties, the Whitney property, and all 3 mines were put into operation in the 1930s.
It's a wonderful thought, this incredible bull market in gold stocks that happened in the 1930s, and many gold investors are hoping is going to happen again. What about if I suggest to you, Ian, that it's already happened? If a lot of people look at Homestake in the 1930s and observe the huge gains that were made, but if you plot a chart of the HUI or GDX, the major gold stock ETF, from 2001 to say 2007 or 2010, and you plot that same chart over Homestake in the 1930s, starting in 1929. You've got one is a virtual mirror of the other. Have we not already had the great move in gold stocks, or is what's coming just going to dazzle us all to the upside?
Well, there's, I think we've got to, what we're seeing really is the collapse of paper. So the collapse of paper assets, we're going to see the collapse of paper money. So the move to gold is going to be enormous. Now, the only issue that I have with this collapse is how do stock markets function during a monetary collapse when there's absolutely no faith in paper money anymore. So how do that's the only kind of issue that I can't get my head around at the moment, and sort of saying, well, if the paper money system collapses because no one have any faith in it, then how does the stock market function? Even how does a gold company that has gold in the ground or is producing gold, how does it get paid for that production? In a monetary system that is effectively in a state of collapse. And this is an issue that, for me anyway, is of paramount importance, because I'm not sure how the system, and in John Law's time, the Mississippi scheme, the stock market big hoopla in the stocks in France in the 1720s, in the Mississippi stock. That continued, even though the paper money system collapsed, the stock market actually continued to function, because once the collapses happened, the French returned to a gold-silver standard. So, but that was immediate. In other words, the collapse was one day, and the next day we're back on a gold-silver standard. I'm not sure how long this collapse is going to take, and because if it's China that leads the return to gold, then what does the United States? How long does it take the United States to come back on a gold standard system? This is very much akin to the collapse of the monetary system in the 1930s, and of course that was the previous long-wave winter. But that collapse was a gold standards or a gold exchange standard system, and a collapse out of gold into paper. And now we're seeing a collapse out of paper back to gold.
Is it possible that it doesn't collapse, that we just muddle through?
I just don't think that's possible, because paper money is debt money, and effectively what we've done now, we've built so much debt into the world economies. I mean, I think the total world debt is in excess of $200 trillion. It just doesn't seem to me that we can continue to manufacture debt ad infinitum.
Okay, you've spoken about a peaking Dow around about March and April. And then after that, a fast rising, or I should say a fast falling Dow to gold ratio. Tell us about your time frame for the rest of the unfolding of winter. I mean, obviously it's totally, you don't have a crystal ball, but what have you got a kind of a model that you're working off? A projection?
Well, I think once the collapse happens, it's going to be pretty dramatic, and much like, if you go back to the last long-wave winter, the total collapse, the effective worst of the collapse in the United States was happened between 1929 and 33. During that period of time, the Dow had lost 90% of its value. GDP in the United States had collapsed by 45%. Unemployment was at 25%. So all these things happened in a very short order. Now, we've been in this winter for 13 years. The Federal Reserve, since the first peak in 2000 in the Dow, and the Federal Reserve has kept the thing going by printing copious amounts of money. And that's really what's keeping the stock market going, because the banks are receiving, courtesy of the Federal Reserve, $1 trillion a year. And what are they going to do to it? There's not too many places they want to lend it out to, because they've been bitten on that. So they're speculating in the markets with all this cash that the Federal Reserve is making available to them. But once a collapse happens, if you go back to 2007 and see the collapse that happened around, Bear Stearns and Lehman Brothers, that's 2007. You went from 14,200 to effectively 6,500 on the Dow by March 2009. That was a big drop, and that happened over a period of less than 2 years. So once these collapses happen, the panic starts to set in, and they go very quickly.
Okay, and I've got two last questions for you. The first is, one of the problems that I have with cycles work in general is that looking back, it's very easy to kind of look back at events in history and then kind of attach some kind of cycle to them, whether it's the 4-year cycle or a Kondratieff cycle or whatever, the 14-year property cycle, whatever cycle it is that you're working with. But in terms of using past cycles to project forward, particularly if you're dealing with something as big as a 60-year Kondratieff cycle, it's very difficult to invest off. They become a bit arbitrary, and they just often don't work.
Well, Dominic, I think our understanding of the Kondratieff cycle has worked. I mean, we know we've been able to indicate quite effectively how to pinpoint the season changes in the cycle, and if you, as I did, went into gold in 2000 or at that peak when the Dow gold ratio was at 44-1 in July 1999, if you'd turned your assets to gold and moved out of the Dow, you would have effectively, and I have effectively, made good money by making that decision. You know, I'm on record showing my portfolio performance since 1999 has been an average annual rate of return has been 47% since that time. I've had some horrendous losses, but overall, that's what I've been able to gain by being invested in gold stocks. So I think 2010 I lost 53%, but again, the overall performance has been 47% since that time. So I think, you know, if you really understand this cycle, and I believe that, you know, I'd like to credit myself for saying, yes, I do, you can make good investment decisions and investment decisions that are going to make you money.
And so let me come back to that question then, Ian. You know, where should we invest our money now? Where are we at the cycle point now? Should we be buying gold now, or should we wait? Or, you know, what about the people who weren't there in 1999?
Well, of course, you know, again, we're looking at we're measuring everything by that Dow gold ratio. So the ratio is, let's say 7.5. I haven't figured it out exactly. We put it on our website every day, but I think it's about 7.5 to 1. We're saying that ratio is going to come down to an extreme low. And so if it's going to be 1 to 1, and as I said, I believe it's going to be 1/4 to 1, yes, you should there's still a lot of upside by being invested both in the physical gold and in the gold equities.
Great stuff. And my last question to you, Ian, if you were to recommend one piece of work on cycle theory and long wave cycles and investing based on these things, which book would you recommend?
You know, I hate to be, so I think that the best place you could be is on our website, simply because I really believe that we've gone way beyond anything that Nikolai Kondratieff ever envisaged. And you know, we've had the advantage of time. He wrote his work in the mid-1920s, so we've had, 90 years beyond Nikolai Kondratieff to sort of really piece the thing together. So there are a lot of writings on my website. It's a free website, longwavegroup.com, and I think that when people look, there's a circular chart that I produce that is a one-page. There's a lot of information on that circular chart, but it's available to readers on the Long Wave to sort of see and understand almost on one page the entire long wave cycle. So I don't know, I haven't written a book about it, but I think pretty well, I wrote a piece in 2007, which I said, this is it. That was the title of the piece, and I basically said the banking system is going to collapse here, the stock market is going to collapse here, and we published that in November 2007. So I think there's a lot of stuff there on the website that people can learn about the long wave, by going back and looking at some of the past writings, and also looking at the significant number of charts that we have available to the readers.
Very good. And the website address is?
Longwavegroup.com.
Longwavegroup.com. And there are also some excellent graphics on there as well. Ian Gordon, it's been a real pleasure talking to you. Thanks very much for coming on the show once again. Hopefully we'll talk to you in maybe 6 months or a year. And in the meantime, keep well, look after yourself, and thanks for putting up with some difficult questions from yours truly.
Well, thank you very much for having me, Dominic.
My pleasure. Ian Gordon, longwavegroup.com is the website.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
by natural law, and what we're seeing here is central banks are trying to impose their own will on the natural way of the markets, and so far they've been successful. But we feel that success is going to be completely destroyed in the coming down once this new peak has been made. And we have a target for the Dow of 1,000 points, the ultimate bear market bottom. And we picked that level simply because this winter bear market is akin to the winter bear market of 1929-32. And that bear market lost 90% of the Dow's value. And we picked 1,000 simply because 1,000 was a very strong resistance point. Initially, 1,000 was hit in 1966 point in time. In fact, effectively, what we're seeing is three highs in the winter bear market. The initial high was in 2000 when the Dow hit 11,750. The secondary peak was made in October 2007 when the Dow hit 14,200. And now we're making a third peak. And interspersed between those peaks, there's been some fairly vicious downside action. And we feel that when this ultimate peak is made, and it could be significantly higher than the 14,200, when that peak is made, the winter bear market cannot be held back any longer. And, we're a big component of markets being effectively managed. And it took 12 attempts for the Dow to penetrate 1,000 and move on. And it finally did that late in 1982. So that resistance point now becomes support. So, and again, we're looking at something akin to the 90% loss that was encountered between 1929 and 32. So 1,000 seems to be a realistic number for a winter bear market.
Now, 1,000 on the Dow, that's a hell of a big target. That's a loss of, goodness knows, more than 90%, 95% from here. You spoke about natural law there, Ian. And if natural law is the law of nature, and positive law, I think it's referred to in philosophical terms, is the law of man, where we try to assert our own laws on the law of nature. Fiat money is very much a positive law, and gold, which is, of course, world supply grows at the same rate as population growth, is very much a natural law. I can't see in winter. Are you still standing by that?
I certainly am, Dominic. This winter has been extended up to this point in time by the central banks printing copious amounts of money. And but they really haven't got to the crux of the problem that occurs at the onset of winter, which is eliminating most of the massive amount of debt that's been built into the economy during the previous 3 seasons of the long wave, and particularly during the autumn.
Very good. And so even though, I don't know, stock markets are nearing to, or some of them, certainly not the Canadian markets, but the S&P and the FTSE are closing down on their all-time highs. Of course, the stock market and the economy are two very different beasts. But a central banker might say, well, actually, printing's worked. Look at the stock market.
Well, that's right. It's worked up to this.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast with me, Dominic Frisby. It is February the 6th, and in today's programme, I'm talking to Ian Gordon. Ian was born into an English military family, but he's been based in Canada for some 45 years now. He's worked in the financial markets as a broker and an analyst for over 30 years, and he's one of the foremost proponents of Longwave theory, of Kondratieff theory. Ian, it's a pleasure to be talking to you once again. You've been saying for some time now that there are 4 seasons to the Longwave cycle, and we're very much